Well, good afternoon. Happy Friday. Mark Milam here, your mortgage professional. Let's get right to what's been happening this week in mortgage interest rates. Kind of a flat week as we prepare for next week, where on Thursday and Friday of next week, we get two really important reports. There's jobless claims, a measure of labor strength. Boy, that's so important, as the Fed has told us. They're looking for softness in the labor market. And then Friday is personal consumption expenditures. That's going to be the report to watch as we start to target a potential rate cut maybe in September. Or is there a chance we're going to see something at the very end of July? Probably not. But as we approach September, that's where the smart money is betting. Let me flip the screen around here and I'll talk about what's been happening this week. It's been a relatively flat week. The past 2 days haven't been fantastic. Why has this sell-off in mortgage-backed securities occurred? Why have we seen a little bit of increase to interest rates over these past 48 hours? There's not really a compelling reason. Volume has been a little limited in terms of trading, but also we've seen some corporate bond issuance that's been higher than anticipated. So the market anticipates a certain amount of auctioning off of bonds, and then if that amount is actually higher, well, it puts more supply out there on the market, which drags down the value, which increases the rate. That's kind of what we're seeing. Again, it's not a big needle mover here. We're mainly keeping our eye focused on next Thursday and next Friday. Speaking of that, let's talk about what's going on with futures traders. So as we look to the next Fed meeting, which is at the very end of this month, the July 31st meeting, right now 95% chance the Fed is going to hold the Fed funds rate steady, less than a 5% chance we're going to see a cut. That feels a little heavy to the everything's going to be held just as it is side. Odds are the Fed's not going to make a cut, but there is a chance that we could see the Fed come in with a quarter-point cut to the Fed funds rate. Why? Well, their language of late has been a little more dovish. They're starting to see signs across multiple reports and month over month over month of weakening data as it pertains to inflation and also as it pertains to labor. Still don't think they're going to cut on July 31st, but I would put the odds a little bit better, maybe more of a 20%, 80% chance versus just less than 5% chance that the Fed might cut rates on July 31st. But here's where all the smart money is going, and that's to September the 18th. And we can see now a 93.5% chance that the Fed is going to cut the Fed funds rate by a quarter of a point there on September the 18th. That's also kind of interesting because September the 18th is coming before the November Fed meeting, and that's right at the time of the election. And my hunch is the Fed's really not going to want to mess with the Fed funds rate in the same month that we have a presidential election, especially a contentious one. Might not be surprised if the Fed doesn't cut on July 31st and we see continued softening of data, that cut that comes on September 18th isn't a quarter of a point, but maybe more along the lines of a half point. All these are just kind of interesting variables to watch. The main thing to know is that this cycle of the Fed funds rate being static and set now for over a year at 5.25% to 5.5%, it's almost over. We are getting ready to enter into the next cycle for the Fed, which is going to be a cutting cycle. That is certainly welcome news for home equity lines of credit, for any sort of short-term instrument. It's also welcome news for mortgage rates, but in a more indirect fashion. Remember here, what the Fed is cutting or raising isn't a mortgage rate. It's the Fed funds rate. That's simply the overnight lending rate to banks and financial institutions. It's not a 30-year fixed mortgage, but as all rates are somewhat correlated with one another, it certainly provides the trajectory down that we're looking for. We need housing to get more affordable. A recent study by Fannie Mae has shown that 1 out of every 4 consumers plans to make a home purchase in the next 3 years, but more than 70% of those same consumers feel like it's just simply unaffordable. That's the angle that we need to attack, and hopefully that's what's about to start. Whether that's at the end of July or moving into September, we do think it's going to be somewhere in the next 60 days. Okay, if you have any questions for me over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.